While most investors are still playing by the old rules, a small group of investors are in the know and are quietly positioning themselves to capture the greatest wealth transfer opportunity in the last 80 years. And I'm going to show you exactly how to do it, or at least we're going to try. The Federal Reserve's decades-long experiment with artificially low interest rates has created the largest asset bubble in modern history. And when it finally bursts, traditional diversification strategies are not going to work. We're witnessing the same pattern that preceded every major economic restructuring in American history, from the Revolutionary War crisis of the 1770s to the Civil War era of the 1860s to the Great Depression and World War II of the 1930s and 1940s, where the old financial order collapses and an entirely new system emerging. All of these examples that I just talked about were transformative, climactic periods in U.S. history, also all happen to be fourth turning cycles. The next 5 years will determine whether you retire well and comfortably with financial security and spend your golden years pursuing travel, hobbies, things like that. Or you could spend years watching younger generations taking advantage of the situation. Basically, the ones in the know taking advantage of the fourth turning climax. Those that know what's going on will benefit. Those that are oblivious to what's going on are going to get hurt. We don't want you to be in that group that's going to get hurt. Welcome back. I'm Mike Preston at New Harbor Financial. Last week, we talked about the fourth turning theory. We went through definitions. We talked about the different parts of the fourth turning. We explained how we think that we're in a fourth turning. A fourth turning happens only once every 80 to 100 years. And during a fourth turning, society faces a major crisis and ultimately a climax that completely shapes how we live, work, and how we invest. We talked about how we're right in the final 5 years of one of these critical turning points, which began with the 2008 financial crisis and will likely continue until about 2030. 5 more years. This explains why your traditional investment playbook, the traditional 60-40, the balanced portfolio, the set it and forget it passive index strategy is not going to work much longer. In fact, it's not even really working that well in today's environment, and it certainly won't work, in our opinion, very well in the next 5 years as we reach the crisis and climax of this fourth turning. There's going to be more geopolitical tensions, more unprecedented market volatility. If history's any guide, this should be a very historic bear market, and maybe this time it will stick. So you really want to make sure that you don't take that ride down and get hurt in the climax of this fourth turning. Here's what I want you to understand. Crisis breeds opportunity. We work with many clients on a regular basis to help them reduce fear and risk and to feel more comfortable about where we are in this fourth turning. After all, that's what we are trying to do, is to give insight and help you to direct your own actions so you can feel better financially and psychologically as we go through this climactic time. So that's what we're going to cover today. I'm going to share specific strategies that have helped other clients thrive during this time, and we hope to help you thrive during this time as well. So during a fourth turning event, it's really, as I said, a climactic time, and volatility is at a peak. Volatility has already been high and is probably going to continue to get worse as we head towards the crisis and the climax. Here's a monthly chart of the S&P 500. You can see here as recently as April, we had a 21% peak to trough drawdown, and then followed by one of the fastest V-shaped recoveries I've ever seen. The last few years have been categorized by these sharp and swift pullbacks, all of which have been followed by V-shaped recoveries. We think as we enter this climax, we are going to have potentially a further blow off top to the upside, but then a crash. And this time that crash will not be able to be rescued. It'll be a transformative time where the investing public will stop believing in the Fed's ability to rescue the market. So valuations as well are completely off the charts. Valuations at these levels are not conducive with positive returns in the S&P 500 over the next 10 years or even 15 years. Here's the NASDAQ. Had a steep drop followed by a very fast recovery. We believe the market will likely top out here sometime in the next handful of months, or maybe as late as the first quarter of next year, but we're very, very late in the game. So those that are playing for additional upside here better be swift and nimble. Hopefully you're using some type of hedges, and if you're not, it's probably not even worth playing the game with this amount of volatility and where we are in the story. You might want to think about just sitting in safe treasury bills, which are still earning over 5%. So volatility is here to stay. Volatility is going to continue, and this is all during a time that valuations are probably 3 times historical norms. The only question is, how long can it last? Will it last forever? It has lasted longer than ever before in modern history, but as we enter this climax, I am betting that it will stick. It won't stay. I think we're going to have more of an L-shaped drop next time, one where the market goes down and goes sideways for years versus goes down and recovers quickly. So that's what you want to avoid. That's what we help people avoid when we're managing accounts for them. So let me be direct about what we're facing. The fourth turning brings 3 major financial risks that most people are completely unprepared for. First, inflation that doesn't go away. Inflation has been really non-existent for most of the last 15 years. In fact, the Fed was adamant about targeting 2% inflation. And because of slack in the system, or because the velocity of money was plummeting all of those years, or because of other conditions that we don't understand, inflation was, at least as reported by the government, darn near zero, below 2%. And the Fed says, we want 2% inflation. And then the COVID crisis came along, and the Fed put $7 trillion of money, both through monetary and fiscal stimulus, into the system. And all of a sudden, shabam, we had 9% inflation post-COVID. And since then, the Fed has been trying to get inflation back down to target. So we'll see what happens next. We think, though, that long term, and we're talking about 2 years to 20 years from now, inflation is going to be really persistent, and it's going to go up and stay up. That's going to be something that's going to really affect the rest of our lives. This type of inflation is not a temporary price spike. When societies restructure themselves, currencies lose purchasing power. These are events that are not days, weeks, or years. They could be decades long. And it's likely something that we're going to face for years to come. Your dollar today buys significantly less than it did 3 years ago, and it's likely to be that way for the next 3 or 5 or 10 years. If you're holding cash or low yield bonds, thinking you're being safe, over a longer period of time, you're likely to lose purchasing power. So we need to talk about alternatives. The second risk, market corrections that last longer and hit harder. I showed in a previous chart just a little earlier in this video that the markets come back every single time post-great financial crisis. The market's been rescued. Every single time there's been a hiccup, the Feds come to the rescue. We've had a V-shaped recovery. Watch out for that L-shaped recovery where the market goes down and stays sideways. That's an L, not a V. That's what we're afraid of, and that's what likely will happen in the climax, in the years that follow that climax. Traditional correlations break down during a fourth turning. Stocks and bonds can fall together. Think about what happened in 2022. For the first time in years, actually decades, bonds and stocks fell together. Here's a chart of the S&P 500 on a monthly scale. I shared this just a little while ago, but this time focus in on 2022. 2022, stocks came in at an all-time high and then fell about 22% at their low. I'm now going to switch to a chart of long-term U.S. Treasury bonds. Take a look at what happened during 2022. Long-term Treasury bonds absolutely collapsed. In fact, that collapse was bigger than the S&P. So if you were in a 60-40 mix, you actually saw bonds go down more than stocks during that time. And look, bonds haven't really bounced too much since that time. Now, I'll be clear, I do think that long-term Treasury bonds are a pretty good buy at these prices, and certainly a much better buy than the S&P. But the point is, you can have a collapse in bonds at the same time that you have a collapse in stocks. And this could actually accelerate during a fourth turning climax and stay that way. Old correlations don't stick anymore. Old basic strategies like the 60-40 balanced portfolio will likely not work going forward. You need to think about other things. You need to think about preserving purchasing power. You need to think about building a war chest of dry powder, cash so that you can buy at lower prices. And particularly when cash is paying 4%, you're not giving up that much. I'm not saying you've got to go 100% to cash, but I am saying think about reducing your allocation, particularly to stocks, build up a war chest of cash. You're going to want to have that in the years ahead. Third risk, policy shifts can change rules overnight. We've already seen this. Tax policy changes, regulatory overhauls, even discussions about wealth taxes and capital controls. What's legal and tax efficient today might not be tomorrow. As we're filming this video, there's talk about reducing or eliminating tax breaks on electric vehicles. There's a lot of things that are going to happen in the years ahead from a regulatory perspective, particularly in a crisis climactic environment. During that type of environment, policymakers pull out all stops and say, it's for the greater good. We have to do it for everyone's benefit. And guess what? That benefit isn't always you, for your benefit. So be careful about that. Be mindful. You want to stay nimble. You want to have some cash to navigate what's coming. Here's the critical point. Passive strategies fail during fourth turnings. The buy and hold approach, the automatic investment into index funds, index investing in general. These strategies were designed for stable, growing economies. If we were in a first turning, great. During that time, everything goes up. It doesn't matter as much. During a fourth turning climax, you can receive damage. And particularly if you're in your retirement years, you could receive damage that lasts for a good part of your retirement. This is what we want to help you avoid. Typical passive buy and hold strategies assume that nearly every time in history is the same. They assume that you're holding for 80 years. And I'll be the first to admit, if you're holding for 80 years, passive strategies will work just fine. But if you're at the most dangerous place in that 80-year cycle, which is where we think we are right now, passive strategies are not likely to work. Passive strategies can be dangerous, particularly if you're in your retirement years. What do you do now? How do you not only protect your wealth, but actually grow it during a fourth turning? That would be ideal. Let me walk you through 4 core strategies that might work for you and that are working right now. Number 1, reduce risk. I've already mentioned this. The first strategy is brutally simple, but emotionally difficult. Reduce risk in your portfolio right now. If you're traditionally invested 60-40, 80-20, or even 100% stocks, reduce risk right now. If you're a passive investor doing this on your own, in my opinion, that means reducing your equities to 30% or less, because we view equities as having the risk of losing at least 2/3 of their value as we go through this climax. If you're down at this level of 30%, you can hold for the rest of your life. You can even add more because you're going to have some cash on the side. But if you're at 60-40 stocks, bonds, 80-20 stocks, bonds, you're not going to have the emotional ability or the financial ability to get more committed. So number 1, reduce risk. And that doesn't mean just going to cash and putting it under your mattress. It means being honest about where we really are here, being honest about stock valuations, being honest about where you think returns are going to be in the next few years, and being honest with yourself about your ability to sell on the way down. That's one thing I've seen over and over again with investors in my almost 30 years in this business. Everyone overestimates their ability to sell on the way down. And when we see the big one, the big correction that sticks, that L-shaped move, you need to sell on the way down. You have to have stop losses and a plan to get out or hedges. We do that for our clients, and I'm trying to help you by saying if you're passive, reduce now. Even if we go a little higher, I don't think the market has a lot more upside, maybe 5 or 10%. But if you reduce now, you're going to avoid that emotional torture on the way down. Second strategy that works here, buying real assets. Both gold and silver have done really well over the last few years. Central banks have been accumulating. During a fourth turning, you need to own things that have real intrinsic value, regardless of what happens to the financial system. We are talking real estate, precious metals, commodities, even collectibles that hold their value. These are assets that maintain purchasing power, even when currencies weaken. I'm not saying sell everything and buy art or collectible wine or even gold, but I'm saying start thinking about some of these things. Have a conversation with us if you don't know exactly what to do. Things like commodities, ETFs, precious metals funds, some real estate selectively. The problem is real estate has been the focus of this wealth strategy by the Fed, so there's a bubble there too. So you've got to buy very carefully. There's ways to gain exposure without being a doomsday prepper. You don't have to go all to silver or gold or any of this stuff. But a little bit of each of these things can make a lot of sense, and you got to do it ahead of time. So the key is understanding when the system goes through this major restructuring, when we see the climax of this fourth turning, you want to own pieces of the real economy, the real world, not just claims on paper profits. This is what the wealthy do. They own property, real estate, businesses, etc. You can't even own stocks. That is owning pieces of real things, but only at the right valuations. The problem is we haven't seen the right valuations really since the great financial crisis, but we believe that there's going to be opportunities that come. Take a look at the monthly chart of gold. It's really the best looking chart I can find in any financial asset out there, really including the stock market, the bond market, anything like that. Take a look at this 20-year chart of gold. Gold hit a high back in 2011. and then it went through an 8, 9 year cup, basically a cup formation or a bowl, followed by a couple of years of a sideways handle formation. This line here is right at around $2,000 an ounce. Gold has blasted out of that consolidation and has moved up to around 3,200 or $3,300 an ounce. As we speak, we don't think the top is in. We think that gold will likely reach 3,800 to $4,000 an ounce in the next year or so. Now, these are speculations, I realize, about the future, but based on the chart and what we think is likely to happen, particularly if we get a drop in the stock market, we think these targets are likely to be hit. Silver has lagged gold a little bit, but it broke out of a big triangle formation back here a couple of years ago, and most recently broke a triple top at $35 an ounce on silver bullion. We think that silver is likely to play catch up to gold as it historically has done. It's a lot more volatile and it moves faster. Take a look at what happened back here in 2011. It squeezed right up to about 48 or 40 or $50 an ounce on silver. We think that silver is likely to move up to the 40s and then take out this high in the next year or so as we enter this crisis and then climax of this fourth turning. Again, this is not a signal to go all in, but if you don't own gold and silver, think about putting 5 to 10% of your investable assets in gold and silver. We can tell you how to do that if you reach out to us. Third strategy you really got to think about is how to prepare yourself mentally. I think the biggest risk that a lot of people are going to face is to be frozen like deer in headlights, just not knowing what to do or not doing anything. If you're a passive investor in a 60-40 or 80-20 plan and you don't do anything on the way down, you're going to be hurt. And it may be okay over 40 years, but if you don't have 40 years or the mental ability to not sell out at the wrong time, it's going to be disastrous for people. So prepare yourself mentally. And probably the most important out of all these strategies I'm talking about, it's the one that most people completely ignore. I started in this business in the 1990s and I watched people during the tech bubble hold stocks all the way down 95%. It's really hard to get out, really hard to get out, easy to get in and hard to get out. So if you've got a concentrated position and it drops, you'll be thinking you're going to wait for a bounce to get out. That bounce doesn't ever recover that first high and it gets worse and worse from there. Or even worse, I think a lot of people that are in treasury bills, that are in the T-bill and chill trade, are going to buy stocks way too soon. They're going to buy on the way down without a plan, and they're going to get fully committed long before the bottom. So think about how to prepare yourself mentally. The psychological stress of watching your portfolio swing wildly and drop month after month is a difficult thing. I remember back in 1999 through 2002, people started referring to 401ks as 201ks. And I know what that's like mentally. I've seen it. I felt some of it myself. People start to avoid looking at statements or logging onto their account, and then they just hope and pray that it gets fixed. And so far, every single hiccup has been fixed, but it won't always be that way. So you need to develop some kind of crisis discipline, the ability to stick to your plan when everything feels chaotic. And if your plan is 60-40 forever, great. Just decide now that you're never going to touch it for decades. But I think a lot of investors are fooling themselves about the risk that they're taking. So if you take my advice and you reduce risk now, I don't think you're going to miss out on much upside. And I think you're going to be way better prepared psychologically to take advantage of opportunities ahead. You're not only going to be able to survive this crisis, you're going to be able to thrive and you're going to avoid a lot of emotional angst. So I hope you take me up on that. So other things you can do to help your psychology. Don't look at the news too much. It's not really helpful. That's something that I've learned. Look at it sparingly. It's good to be informed, but if you look at it too much, it's not really that helpful. Focus on what you can control, not on what you can't. Importantly, accept that the period of instability that we're likely to see ahead isn't just super temporary. It's the new normal, at least for the next 5 years, approximately, as we go through this climax of this fourth turning. There are brighter days ahead. After the fourth turning, as I talked about in the last video, there's a first turning or an awakening. This is a wonderful time. This is the time of massive economic growth and optimism. But we have to get through these next 5 or 6 years. First, we want you to get through there whole without really being decimated financially and psychologically. And so if you do some of these things that we talked about ahead of time, you're going to make much better decisions and you're going to avoid a lot of turmoil, psychological turmoil. Fourth strategy. Talk to a professional who understands the moment that we're in. that isn't a passive asset allocator. And I know this might sound self-serving, and I don't just mean talk to us, but if you want to talk to us, great. We'd love to talk with you. There's others out there that are trying to be active managers that have been relatively humbled, I should say, these last 10 to 15 years. They're out there. Make sure when you talk to a professional that they have some discipline that's different than passive buy and hold. Ask them, what types of decisions do they make getting into the market? Or how do they make their decisions getting into the market? How do they decide when to get out? How do they decide what type of asset allocation to have? How do they decide what percentage to have in stocks? If they say, well, we have a questionnaire for you, and based on your answers, we put you in an asset allocation, and that's where you are forever, that's a passive buy and hold advisor. That's not what you're looking for. Look for somebody that says, we take your situation into account, but also, and maybe even to a greater extent, we take into account what the market is actually saying and doing. And then we try to align your risk profile with that. Those are the types of advisors you want to talk to. It's impossible for everyone to know everything in this life. I've spent a lifetime learning this, and I'm still learning, and those of you that are watching that might be doctors or other types of professions, you've spent a lifetime learning what you do. So again, passive buy and hold works over 80 years. You could just throw everything out the window and do that, but that's not during this time. Maybe at the bottom of this fourth turning, at the peak of the crisis. And when we climax in this fourth turning, that's going to be at a much lower stock market valuation. You can be a little more liberal about passive during that time. This is not that time. So if you don't feel like you've got the tools or experience to navigate that, talk to a professional. Talk to us or talk to anyone else that has the characteristics that I just mentioned. Active management, measuring risk in the market, and then taking a risk exposure with your money based on what the market is saying and what the market is doing. Let me tell you why I do this work and why I think New Harbor Financial is different. My job isn't to predict the future. Nobody can predict the future. My job is to help you stay calm and confident no matter what the markets do. That's real resilience. To build portfolios that can weather storms and take advantage of opportunities. To be your steady hand when everything else feels unsteady. To be your financial therapist if need be. We have a lot of experience, and that experience comes at a price. That experience comes with time. That experience comes from learning difficult things. The experience that we have over this time, developing the thick skin that we have, didn't come easy. It comes with experience, and there's value in that. Let us help you with that, and we're happy to do it. So where do we go from here? How do you take control of your financial future in these uncertain times? First of all, don't wait. The cost of inaction during a fourth turning is simply too high, particularly if you're at the wrong point in that fourth turning. Every month you spend with an inappropriate investment strategy is a month of opportunity lost, or potentially a month closer to the top, or a month closer to an ultimate crash. We happen to be sitting at all-time highs in the market. I think we likely have more time. We likely have months more time before a turn, but we don't know that for sure. So don't sit too long with inaction. Think about some of these things that we talked about and make a plan of change. Second, get a professional assessment of where you stand. I'm offering complimentary portfolio reviews. Reach out to us. We're happy to have a 30-minute conversation. We'll look at your current allocation, identify vulnerabilities, and discuss strategies that make sense for you specifically. No sales pressure, no obligations. Just an honest assessment of where you are and where we think you need to be. Here's what I want you to remember. Fourth turnings are times of incredible risk and incredible change. They're also times of incredible opportunity. There's always a silver lining. In this case is no example. The key is to have the right plan, the right mental attitude, and the right support system in place. And I might add also the right allocation ahead of time if you're going to be more passive about it. With the proper preparation, you don't just survive times like this, you can actually thrive. You can be better positioned for whatever comes next. You can actually prosper during this time. You'll be able to enjoy and grow even more in what comes next. And this is the major silver lining. The first turning, also called the awakening. The last first turning, the awakening, started in 1946 after World War II and lasted all the way to the mid-60s. This was a time of major economic expansion, two-income families for the first time. Many families had 2 cars, small house in suburbia. This is what I'm talking about. You need to get through this fourth turning and look forward to that great time, the first turning. It will come. The climax of this fourth turning will come, whether we like it or not, and the first turning will come. So you want to be prepared for that. I'm Mike Preston at New Harbor Financial. Thanks for watching. Please remember to like the video, subscribe to our channel. We appreciate all your views. We appreciate you subscribing, liking this video. And we appreciate your comments below. We read all of them, so please do comment below. I look forward to helping you thrive in the years ahead. I hope you found this educational. I hope this makes you feel better if you have any angst or anxiety, and we're here to help you. Just reach out. That's what we're here for. Thank you so much for watching.